Are growth stocks dead? Or did we just collectively forget that trees don't grow to the sky? Because after watching some of the most beloved tech darlings shed 30, 40, even 60% of their value over the past couple of years, that question isn't rhetorical anymore, it's survival. We're talking about a market where the NASDAQ lost nearly a third of its value in 2022 alone, wiping out trillions in wealth faster than a Fed press conference can ruin a Monday morning. The stars of the pandemic bull run, the stay-at-home heroes, the unprofitable hypergrowth names went from magazine covers to cautionary tales almost overnight. Here's the catalyst. When interest rates were sitting near zero, investors were essentially paying for dreams, and growth stocks were the dreamiest asset on the menu. But the moment the Federal Reserve started hiking rates at the fastest pace since the 1980s, the math changed suddenly. $1 of profit 10 years from now is worth a lot less than $1 of profit today. Think of it like this. Low rates are like a wide open highway where fast, flashy sports cars, your growth stocks, can floor it without consequence. High rates are like traffic, potholes, and a speed camera every half mile. Suddenly, the reliable pickup truck, your value stock, starts looking a lot more attractive. The irony is almost painful. For years, value investors were mocked at dinner parties while growth guys were buying Teslas and tweeting about disruption. Now, the same people who called Warren Buffett out of touch are quietly Googling what a price-to-earnings ratio actually means. Sentiment shifted hard, and you could feel it. The Reddit threads got quieter, the SPAC enthusiasm evaporated, and suddenly everyone rediscovered the radical idea that companies should, make money. But here's where it gets psychologically interesting. Conviction is a fragile thing, and a lot of retail investors who piled into growth at the peak are now paralyzed, too scared to hold, too hurt to sell. History tells us this story has a familiar shape. Growth outperforms in low-rate, high optimism environments, and value tends to reassert itself when reality comes knocking with a clipboard and a bill. We saw this after the dot-com crash in 2000, when the NASDAQ took 15 years to recover its highs, while boring dividend payers quietly compounded in the background. Every cycle feels different because the technology is different, the companies are different, and you personally are different, but the underlying human behavior, fear, greed, and overconfidence runs the same software it always has. There's a humbling lesson in knowing that the smartest people in the room in 1999 also thought it was different that time. Growth and value are not enemies, they're just different chapters in the same economic novel. And right now, we might be turning a page. Community voices across investing forums and institutional research desks alike are pointing to financials, energy, and industrials as the quiet comeback kids of this decade. One big misconception we need to kill right now is that rotating into value means settling for mediocrity or slow, boring returns. Value investing done well isn't about buying bad companies cheap. It's about buying good companies that the market is temporarily ignoring, which is arguably the most rational bet you can make. Another myth worth bearing, that growth stocks are permanently broken or that innovation is over. The sector will recover, it always does, but the question is whether you can afford to wait 5 to 7 years for mean reversion, while a value tilt is generating real returns in the meantime. So what do you actually do with this information? You don't panic sell everything, you don't go all in on any single thesis, and you absolutely do not let financial Twitter convince you that the trade of the decade is obvious and risk-free. A disciplined rotation, gradually tilting your portfolio toward value-oriented sectors while maintaining diversified growth exposure, is how you play this without betting the house. Position sizing matters more than being right about the direction, and history backs this up repeatedly. You can have the correct macro thesis and still blow up your portfolio if you concentrate too aggressively. So let process protect you when conviction is cloudy. There's a philosophical truth hiding underneath all of this market noise. The investors who survive long enough to compound wealth are rarely the ones with the hottest takes. They're the ones with the most boring, consistent habits. Discipline isn't glamorous, but it's the only edge that doesn't expire. At the end of the day, you don't have to be certain about whether growth or value wins the next 3 years. You just have to be prepared for either outcome with a rational allocation you can actually stick to. Comfort with uncertainty, paired with a structured plan, is genuinely more powerful than any prediction any analyst has ever made on television. And whether the market rotates violently or grinds sideways for years, the investors who come out ahead will be the ones who stayed in the game, stayed diversified, and never let a headline rewrite their strategy. That's not exciting advice, but exciting advice is usually how people lose money. If you're ready to take a more strategic approach to building real, tangible wealth beyond the stock market, whether through real estate investing, home contracting projects, or connecting with the right lenders, check out our links in the description below and let us help you get started.